All right, so let's dive into this idea of investments that can bring growth and income.
Okay.
Specifically, we're looking at two Vanguard ETFs today.
All right.
The Dividend Appreciation Index Fund,
Oh.
or VIG for short, and then the Consumer Staples Index Fund, VDC.
Got it.
And, we're thinking long-term here, and I'm kind of wondering how these ETFs could fit into that strategy, especially with everything going on in the markets these days.
Right.
So let's unpack all that.
Yeah, what's interesting to me is that a lot of people are looking for that balanced growth A&D income.
Right.
Like traditionally, it was one or the other.
Yeah.
But these ETFs might be able to give us both.
Okay, so before we get into the specifics of VIG and VDC,
Sure.
Let's quickly touch on why long-term investing is usually the preferred way to go.
Yeah.
It's not just about patience, is it?
No, not really.
There's more to it.
Yeah, it's about using the power of compounding.
Okay.
Like, think of it this way. Your returns start making their own returns. Right. And then those returns make even more returns.
Interesting.
It's like a snowball.
Okay.
But with money.
Got it.
Growing over time.
So it's not just about how much you put in,
right,
but how long it has to grow.
Exactly.
Makes sense.
Yeah, and dividend-paying investments fit into this really well.
Makes sense.
They give you that stream of income while you're invested for the long haul, like getting paid to wait.
Okay, I like that.
Yeah, and then ETFs like VIG and VDC package up a whole diversified portfolio for you.
Right.
Makes it a lot easier to manage.
A diversified meaning?
Meaning they hold a bunch of different stocks.
Oh, okay.
So you're not putting all your eggs in one basket.
Right.
Yeah.
Spreading the risk.
Exactly.
Okay, so let's get into the specifics then.
Okay.
First up is VIG.
Right.
The Dividend Appreciation Index Fund.
Right.
What's the main thing about this one?
Well, VIG focuses on companies that have a really solid history of increasing their dividends.
Okay.
Steady, reliable growth. Businesses that share their success with investors through those dividend increases.
And I saw that it has a current dividend yield of 1.7%.
Yes.
That's better than the S&P 500 average, isn't it?
That's right.
Okay.
And it's got some big names in there, too.
Like?
United Health Group,
Okay.
ExxonMobil, Home Depot.
Home Depot. I don't really think of that as a dividend stock.
I know, right?
Okay.
That's the thing with VIG. It has 338 stocks
Wow.
across lots of different sectors.
Okay.
The diversification we were talking about.
Right.
And here's where it gets interesting. The biggest sector in VIG is actually tech.
Really?
Yeah, about 24% of the portfolio.
Isn't that unusual for a dividend-focused ETF?
Yeah, you'd think it would be more traditional sectors like utilities or consumer goods.
Right.
It used to be that way.
Okay.
But things are changing.
Mm-hmm.
Even those big tech companies are making dividends a priority now.
Mm.
It's a sign that their businesses are maturing.
Makes sense.
But also, it's what investors want. They want growth from tech.
Yeah.
But with a little stability and income, too.
So VIG is adapting to that new reality.
Exactly.
Which explains why it's kept up with the S&P 500 for the last 20 years.
Yeah, not bad.
Not bad at all. And what about the fees for this one?
Oh, the expense ratio is only 0.06%.
That's pretty low.
Yeah, it means more of your money is actually working for you.
Not going to fees.
Exactly.
I like that. Low fees are always good.
Yeah.
Okay, let's move on to VDC then. The Vanguard Consumer Staples Index Fund.
All right.
This one is all about those essential companies, right?
Absolutely. VDC invests in companies that provide the things people always need,
Okay.
no matter what's happening in the economy.
Right.
Food, beverages, household products.
Right.
All that stuff you can't live without.
Yeah, the essentials.
Exactly.
So even if there's a recession,
Yeah.
people are still buying groceries and toothpaste.
Exactly.
Okay.
That's why it has a pretty good dividend yield.
What is this?
2.5%.
Oh, wow.
Way higher than VIG's. Names like Costco,
Yeah.
Coca-Cola,
Yeah.
Colgate-Palmolive.
Right.
All the
The
class.
things you see everywhere.
Yeah, solid and dependable.
I did notice, though, that VDC has fewer stocks than VIG.
Right.
Only 105?
Yeah.
Does that make a difference?
It means it's less diversified. Its performance is more tied to how those top companies do.
Okay.
So there's potential for stronger returns if those companies keep doing well.
Right.
But it also could be a little riskier than VIG,
Got it.
since VIG spread out more.
But we're talking about the long term here, right?
Yes.
So even with all the inflation worries,
Right.
consumer staples should still grow over time because...
People always need these things.
Yeah.
And these companies can usually raise prices,
Uh-huh.
keep up with inflation.
Without losing customers.
Exactly.
Okay.
And historically, VDC has done better than the S&P 500.
Really?
Yeah, though not so much lately.
Okay.
But it still has a pretty low expense ratio.
What is it?
8.10%.
Okay, not bad.
No.
So we've got these two ETFs,
Yeah.
both offering growth and dividend income,
Right.
which is pretty rare
It is.
and potentially really valuable,
Yeah.
but they have different ways of doing it.
They do.
VG is all about companies that consistently churro their dividends over time.
Yes.
And VDC is more about a higher yield right now,
Exactly.
even if the growth might not be as strong.
Right.
And then VG has more diversification,
Yeah.
while VDC is more focused on those big consumer staples companies,
Uh-huh.
which makes me wonder,
Yeah.
with everything going on in the economy,
Right,
with
yeah.
all the uncertainty and inflation,
Sure.
which approach is going to be better in the long run?
That's the million-dollar question.
It is.
And it's one we're going to dig into a lot more.
As we continue our deep dive.
Exactly. Yeah, it really is a big question for a lot of people these days.
It is.
And, there's no single right answer.
Right.
It depends a lot of things, but if we understand how these ETFs are built,
Right.
that can give us some clues.
All right, so let's get into that then.
Go on.
When I first looked at VH, I have to admit, the
Yeah.
name dividend appreciation,
Mm-hmm.
it just sounded kind of, bland.
I get it.
But then I thought about it.
Yeah.
It's not just about getting dividends.
Right.
It's about those companies that keep raising them
Right.
year after year.
Exactly.
That's where the real potential is.
That's it. It's like getting a raise
Okay.
from your investments.
I like that.
And that's what makes VAG kind of cool.
Yeah.
It's not about settling for slow, steady returns. It's about finding those companies that really want to grow.
Yeah.
A&D reward their shareholders.
And the fact that it's performed as well as the S&P 500 for the last 20 years
Yeah.
suggests it's not just about dividends. There's actual growth there too.
There is. And we can't forget about those low fees.
Right.
A 0.06% expense ratio is great.
It is.
Means more money ends up in your pocket, not with a fund manager.
It-
That makes a big difference over time.
It really does.
Yeah.
Okay, compound returns, A&D, low fees. I'm liking this.
Right.
Now, I'm curious about VDC, though.
Yeah.
And those consumer staples, it seems so,
Basic.
yeah, I guess fundamental.
It is fundamental.
Right.
It's like no matter what's going on in the world,
Mm-hmm.
people need to eat, drink, clean their homes, take care of themselves,
Yeah.
and those basic needs.
Right.
That's what makes VDC really interesting,
Especially now.
especially now when everything feels so uncertain.
Right. Like if people are cutting back because of inflation or worrying about a recession,
Right.
they're probably not going to cut back on things like groceries or toothpaste.
They're not. That's what makes it so stable for investors.
Okay.
It's always been a pretty resilient sector, even during tough times.
Mm,
I mean, it's not immune to market changes, of course,
right.
but it tends to hold up better than, say, tech or luxury goods.
When things get bad.
Yeah, exactly.
So if someone is really worried about a recession,
VDC might be a good option for them.
it could be. But as always, do your own research.
Of course.
You've got to consider your own goals,
Right.
your risk tolerance. There's no guarantees when it comes to investing.
Absolutely not.
No,
But it's helpful to look at how these things have performed in the past.
for sure.
You mentioned earlier that VDC has a higher current dividend yield than VIG,
Yes,
2.5% versus 1.7%.
that's right.
That's a big difference.
It is.
Why is that?
Well, it comes down to how the companies in each ETF use their money.
Okay.
Consumer staples companies, the ones in BDC,
Mhm.
they tend to pay out more of their profits as dividends.
Okay.
They're often bigger, more established businesses. They have
Okay.
consistent cash flow.
So they can support those higher payouts.
Exactly.
It's not necessarily that they're growing faster than the companies in VIG.
Right.
It's more like a different way of sharing profits with investors.
That's a great way to put it.
So some companies are more about reinvesting to grow in the future.
And others are more about giving money back to shareholders through dividends.
Exactly.
That's an important difference.
It is. It's not just about the name or the yield.
Right.
It's about understanding the strategy behind it all
Okay.
and what those numbers actually mean.
Which takes us back to that
Yeah.
question of which approach is better.
Right. Given everything that's happening.
Exactly. And speaking of that,
Yeah,
we talked about how VDC is less diversified than VIG.
we did.
What does that mean?
Wow.
Especially in a market like this.
Diversification is all about spreading risk.
Okay.
The more diverse your portfolio,
Uh-huh.
the less likely you are to be hit hard if one investment does poorly.
Right.
So theoretically, a more diversified ETF like VIG
Yeah.
should be less volatile than VDC.
So if someone is really worried about risk,
Yeah.
they might lean towards VIG then.
Maybe, but remember, diversification isn't just about the number of holdings. It's also about the types of companies and how they're related.
Right.
Even though VDC has fewer holdings,
Yeah.
it's still considered diversified within the consumer staples sector.
Okay.
It's not like they're all in the exact same industry.
Right, right.
You've got food, beverages, household products, personal care, all sorts of things.
So there is a range within that sector.
There is.
It's about finding what works best for you
Exactly. What level of risk you're comfortable with.
and what your goals are.
Exactly.
And that might change depending on what's happening in the economy.
Right. For example,
Yeah.
right now we're dealing with inflation, interest rates are rising, and there's talk of a recession.
Right.
How might those things affect VIG and VDC?
Okay, now things are getting interesting.
Right.
I know some of our listeners are probably wondering the same thing.
They probably are. Well, inflation is a tricky thing.
Okay.
It can be good for companies because they can raise prices,
Right.
and that can lead to higher profits.
But their costs go up too, right?
Exactly. So it can squeeze their margins.
So it's not just about being able to raise prices.
No.
It's about doing it without losing customers
Right. Yeah.
who might go find a cheaper option.
Yeah.
And that's where things get interesting when we look at VIG and VDC,
Yeah.
consumer staples. What VDC focuses on are usually seen as a good hedge against inflation
Yes.
because people need those products no
Exactly.
matter what the price is.
People got to eat. Right.
Exactly, even if the cost of food goes up.
Yeah.
So does that automatically make VDC the better choice?
Well, not so fast.
Okay.
Yes, VDC's companies can usually raise prices,
Uh-huh.
but their costs are rising too.
Right.
And VDG, while it's more exposed to sectors that are sensitive to the economy,
Right.
also has companies that could benefit from inflation.
Weak.
Think about healthcare.
Okay.
It tends to do well when inflation is high.
So both ETFs have companies that could be helped or hurt by inflation.
They do.
So it really depends on the company.
It does, how well they can adapt.
Right. Makes sense.
That's why it's important to look closely at the specific companies in each ETF.
Do your research.
Yes. And now let's talk about interest rates.
Okay.
The Fed has been raising them like crazy to try and control inflation.
Yeah, I've noticed.
How does that affect our ETFs?
Well, I know higher interest rates make it more expensive for companies to borrow money,
Yes.
and that can impact their growth and profits.
Absolutely. Companies with a lot of debt
Right.
are going to struggle more.
Than those with less debt.
Exactly.
So debt levels are something to pay attention to.
They are, for sure.
I've also heard that higher interest rates can make dividend stocks less appealing overall. Is that because investors might find better returns elsewhere,
That's part of it, yeah.
like in bonds?
Yes, when bond yields go up,
Huh?
they become more attractive,
In dividend stocks.
especially if those dividend yields aren't keeping up with the rising rates.
So could VIG and VDC become less popular if rates keep going up?
It's possible. But it's important to remember that dividend stocks aren't just about income.
Oh, okay.
Their price can go up too.
Right.
That's called capital appreciation.
So even if the dividend yield isn't great compared to bonds,
Yeah.
the overall return might still be good.
Exactly.
And a lot of the companies in VIG and VDC have raised their dividends even when rates were rising.
They have. It shows their commitment to those payments.
Okay, now one big difference between these two ETFs
Yeah.
is what sectors they focus on.
Right.
VIG leans towards tech, all about that growth potential, while VDC sticks with consumer staples,
Yeah.
more traditional, more stable.
It's like choosing between a speedboat and a sailboat.
That's a perfect analogy.
Right.
And it seems like there's no right answer.
No.
If you want aggressive growth, VIG might be better.
Yeah.
But if you prefer stability and consistent income,
VDC might be more appealing.
so both have risks and rewards.
Absolutely.
Tech can be volatile. But it's also where a lot of the innovation is happening. Consumer staples are more predictable, but they might not grow as fast. It's all about finding what fits your strategy.
Exactly. And understanding how those characteristics play out in different economic conditions.
Okay, so VIG holds companies like United Health Group,
Yep.
ExxonMobil, and Home Depot.
Right.
What makes them stand out as long-term dividend growers?
Well, United Health Group is a leader in healthcare,
Okay.
and that's a sector that's just going to keep growing.
As the population ages.
Exactly. They've been increasing their dividend for years.
And probably will continue to.
Most likely. And then there's ExxonMobil.
Yeah.
Despite all the talk about renewable energy,
Right.
they're still a huge player in the energy sector.
And they've been paying dividends for over 100 years.
That's right. Talk about reliability.
Wow.
And then Home Depot.
Uh-huh.
It hasn't always been seen as a dividend stock,
Right.
but they've been doing really well.
Benefiting from the strong housing market.
Definitely. And they've been investing in their online presence
Okay. Yeah.
and their supply chain.
Smart.
Yeah, so even within VIG,
Yeah.
you see different ways to grow those dividends.
It's about the individual company.
It is, not just the sector.
Okay. And then VDC has those big names.
Mm-hmm.
Costco, Coca-Cola, Colgate, Palmolive.
All about global reach, brand loyalty, and those steady dividends.
Yeah, they're everywhere.
They are.
And people use their products every day.
Exactly. That's why they're so attractive to investors.
Especially when there's so much uncertainty.
Absolutely. It's worth noting that VDC actually outperformed the S&P 500 for quite a while.
Really?
Yeah, up until a few years ago.
So what happened?
Why that change?
Yeah, was it just because tech was doing so well?
It's probably a few things.
Okay.
Online shopping has really shaken things up.
Right.
It's put pressure on some of those traditional consumer staples companies.
Mm.
Plus, consumer tastes are evolving.
Okay.
People want healthier options,
Uh-huh.
natural and organic products. That might not be the strength of those big brands in VDC.
So they're facing challenges,
They are.
but they're adapting too.
They are. It's a constantly changing world.
Which brings us back to our original question.
Right.
With all these factors, inflation, interest rates, changing consumer habits, which ETF looks better for the future? VIG or VDC?
It's tough to say. They both have their pros and cons.
Right.
VIG, with its focus on dividend growth and its exposure to tech.
Yeah.
It might capture more of that future growth,
Okay.
but it's also more sensitive to changes in the economy.
Right.
VDC might be more stable
Uh-huh.
with those essential goods and services.
And a higher yield right now.
Exactly. But it might not grow as fast as VIG.
No easy answers.
There aren't. It really depends on your personal goals,
Okay.
your risk tolerance,
Right.
and how you see the economy playing out.
It's not about picking a winner.
It's not.
It's about choosing the right tool for the job.
I like that.
Well, we've covered a lot today.
We have.
Any final thoughts for our listeners?
Investing doesn't have to be scary.
Okay.
Take your time, do your research, and don't be afraid to ask a financial advisor for help.
Good advice.
It's your money, your future.
Well said. Knowledge is power.
It
The
is.
more you know,
Yeah,
the better decisions you can make.
exactly.
Well, thank you so much for joining us for this deep dive into VIG and VDC.
It was my pleasure.
We hope you found it helpful. Until next time, happy investing.